All right, let's quickly shift focus from all the headlines and focus on the breaking news that's at the bottom of your screen. The May CPI figures have come in at 4.87 as against the expectation of 4.8 that we were expecting. So 4.87, and that shows that some bit of inflation has seen some bit of an uptick. Let me take it across to my guests, Siddharth Sanyal, Chief India Economist at Barclays, Saugata Bhattacharya of Axis Bank, Maithili Busnarmath also joining me, and also R. Shivakumar of Axis MF. Let me first take it across to you, Saugata. How do you look at the CPI numbers? We have seen some bit of an inching. IIP also coming in at 4.9% versus 4.4% for the month of March. So growth has picked up, but so has inflation. Saugata, can you hear me?
I lost you for a second. Okay. So the CPI numbers are exactly bang on target. 4.9. The IIP growth numbers are slightly lower than what we had thought. 5.7 was our estimate. We exactly on inflation, exactly on predicted lines. And more importantly, I think if it moves on this trajectory, it will be lower than the RBI H1 prediction of 4.8 to 4.9%. It should be a little bit lower. Of course, there are multiple risks on the outside. But I think the situation is much more stable now in terms of the pricing. Oil seems to have, despite whatever is happening, oil seems to have stabilized more or less and at these levels. So, but there are key risks to inflation now. The monsoon seems to have stalled. So we need to be very, very cautious on inflation, but I don't think it's going to get out of hand in any meaningful sense.
All right, let me also ask Siddharth Sanyal. Siddharth, do you also believe that we've pretty much, the inflation is still within the RBI's own comfort zone? And what do you make of the IIP numbers? Because the expectation was that it may come around 5.7%, but only around 4.9%.
Yeah, neither of the numbers today is really a surprise to me, at least. We were expecting both these numbers at 5%. Compared to that, the 4.9% CPI as well as 4.9% IP, both are slightly softer. Broadly on the CPI number, we are clearly at a phase and towards the fag end of the phase where the CPI number keeps moving higher, to some extent due to the usual seasonal pattern of hardening in food prices, but more so because of a statistical factor of an adverse base, when numbers will be going up for one more month. But after that, there is possibly a spell of softening unless something really surprising happens. So overall, our sense is that if today's number is 4.9%, it gives me more confidence about the near-term peak, which we were sensing somewhere in the mid 5% zone. My sense is that there is a possibility of that number, a decent possibility of that number staying well within that particular number, and that should be somewhat comforting for us as well as policymakers. So we see a near-term peak in the month of June, somewhere in the 5% handle, but at the same time, the number can potentially move lower in the subsequent months. And I agree fully with Saugata what he mentioned, that it should offer more comfort to the RBI's current first half projection, which they have announced earlier last week in their policy announcement.
Right. Let me also take it across to Mr. Shivakumar. Mr. Shivakumar, how are you seeing the numbers? Growth has risen, inflation is steady. Do you believe this trend is going to continue in the long term? There is no worry as far as RBI's own inflation target is concerned?
No, absolutely. I think as Saugata mentioned just now, it does appear that the inflation number is come bang on, but more importantly, it gives some kind of confidence that the near-term inflation trajectory at least indicates that we may be slightly undershooting the RBI's projection. So what that means is, of course, that gives some comfort to RBI. But I think much more importantly, RBI will overlook this. We know there's a bump up on account of the base effect. And even for IIP, I think, yes, there is a base benefit. So we should have seen a slightly higher print. But IIP has been a volatile series. So we're not taking that too seriously. I think from an inflation standpoint, RBI has just put in a rate hike. And that's a precautionary hike, and if inflation sticks to the original trajectory, then we should soften back to the mid-4s by the end of the year, and that will give RBI a lot of comfort.
Right, May food inflation is coming in at 3.1% and fuel inflation at 5.8% versus 5.24% that we saw last month. Maithili, how are you reading the numbers given the fact that now oil prices have in a way stabilized? Do you believe that this will be some bit of a comforting factor? All the other panelists are of the opinion that inflation is not going to overshoot the RBI's target. How do you see it?
Well, the RBI's target for the first half year is between 4.8 and 4.9. So since this is only the first 2 months or the first half year, April and May, we saw April coming in at 4.6 and now this is close to 4.9. So I think it's a little early for us to say whether the RBI's target for the first half year, mind you, I say that's for 6 months and all we've had so far is data for just 2 months. So it's a little early for us to say, and even though oil prices seem to have stabilized, remember oil is an extremely volatile commodity. Add to fact the summer months invariably see vegetable prices going up, and we already had the farmers' agitation which has caused some amount of disruption in food supplies. So I think it's a little early to say, but so far yes, inflation trajectory more or less on the lines that everybody is expecting. So I wouldn't call it comfort for the RBI, but not excessive cause for worry, and the RBI's rate hike was clearly preemptory given the fact the way the global factors are firming up.
Absolutely. Let me take it back to Siddharth Sanyal. Siddharth, as far as growth is concerned, we still, we were expecting higher numbers this time around, but at 4.9%, if you look at manufacturing, that has come in at 5.2%, mining at 5.1%, electricity production has seen a dip at 2.1% versus 5.9%. How do you read the internals? But there's a big jump in the capital goods, however.
Well, the trend in IIP, especially the monthly numbers, you need to interpret with a lot of caution. What I personally tend to do, try to see that how a slightly more stable CD, something like a 3-month moving average is moving at this juncture, which shows that at this moment it's kind of moving broadly sideways or giving some bit of comfort for the manufacturing side, but it's not a particularly a situation of exuberance in any possible way. Now, what we can see that given that right now we are enjoying, again another statistical factor, the extremely low base of H1 2017, which was the case soon after the demonetization period. We will be seeing the overall growth numbers might actually be slightly on the higher side. For example, the 7.7% GDP growth number in the latest print was not really a surprise, and we do expect the subsequent print to inch up slightly higher, closer to 8%, before they start softening again a bit. Overall, we do think for the year as a whole, we pencil in something in the mid 7% zone for the overall GDP growth, which will be a clear improvement compared to the 6.7% number for the previous financial year. But at the same time, given the play of the the benefit of the significantly low base, the 7.5% number should be interpreted with an additional bit of caution as possibly the key point I would like to drive home.
Absolutely. Absolutely. Saugata, let me come to you. We've seen a big jump in capital goods. Last month, we'd seen a a degrowth of 1.8% and this time a growth of 13%. Do you believe this trend is sustainable, and does it reflect, any sort of investment activity that could be picking up on ground?
I think it does, actually, because so remember, the first thing is that this 13%, a large part of that is commercial vehicles. Commercial vehicle sales in April was about 78%. So this was due to a base effect of a contraction because of the GST induced a slowdown in production, etc. Last April. So this was a jump. But having said this, I think we are distinctly seeing now some signs of a revival in capital goods. In steel, for instance, is running at a very short, very low inventory margin. So, I mean, is very close to capacity utilization. So, steel demand is high. Industrial bearings, motor parts, power transmission equipment. So, we are definitely seeing signs of a revival in investment. It's not the big ticket investments that we were seeing so far, but a lot of capital goods related activity. Related to the highway construction projects, which is clearly the construction equipment and commercial vehicle segments, a lot of electrical equipment, a lot of machinery. There are some signs of an increase. And the Reserve Bank of India itself mentioned that due to that, they haven't disclosed the capacity utilization. Capacity utilization numbers for March are apparently pretty high, and they themselves felt that the potential output gap is pretty much now closed. So this is unlike in the past when there was a lot of consumer durable led growth in industry. So this time there are signs that this is a capital goods driven growth. So capital goods is contributing, and there is some investment activity which is reviving.
Maithili, do you also believe that, while we are not seeing big ticket investments so far on ground, there's some sort of fresh investments that are coming in, at least the smaller ones, and does it reflect the wider trend that probably now, we're way past that hump?
Was that addressed to me?
Yeah, Maithili.
Yeah, so clearly, because if you look at the RBI's latest monetary policy statement, they had seen clear evidence of capacity utilization picking up, and the fact that high growth indicators, frequency indicators did show increase in economic activity. So certainly the IIP should look up. In fact, it's a little disappointing at 4.9%, because from November last year, IIP had consistently come at over 7%. So there was hope that the economy was firmly on the growth trajectory, the recovery trajectory. So latest numbers are a little disappointing. Yes, capital investment, and if you look at capital formation, capital goods, it does seem to have looked up. But capital numbers, capital formation numbers, whichever way you look at it, capital goods numbers as a percentage of GDP, in the breakup of the IIP, they've been notoriously volatile. So it's very difficult to draw any conclusions from the capital goods and the output. But this one number for IIP certainly is disappointing for the month of April. Hopefully, as we go forward, particularly June, since it had shown a contraction, it will have that base effect and make it look as the economy is doing better. But I think it's early days as yet for us to say the economy is out of trouble as far as the growth front is concerned. I think on inflation we have fewer worries. On growth, the worries still remain.
Mr. Sivakumar, let me come to you. Do you also concur with that view that, in the long term, we have to still be cautious of the way things are moving? And what about the mining number as well? We have seen April mining coming in at 5.1% versus 2.8% in the month of March. But given the fact that now we are fast approaching the monsoon season, do you believe that we may see a blip going forward?
The individual breakups, I mean, to the extent of mining, etc., I think we are getting too much into the weeds. But the capital goods number is certainly worth watching. I think much more important from a RBI policy perspective, because I think RBI is clearly using some evidence of strength in capital goods numbers to justify the rate hikes. So they need a period where they can point to some strong growth and say that these rate hikes that they're embarking on is not disrupting growth and it's only aimed at inflation. Had we had a very weak capital goods number, for example, then there will be a lot of worries that RBI is hiked too fast and too soon. So I think the fact that you have a decent capital goods print and potentially in the next few series you will have a decent IP, as your other guests have also alluded to, the weak base effect last year because of demonetization and GST, just gives a little bit of cover for RBI to put up rates, and that's the way we are seeing it. This is a period where inflation is reasonably along previously indicated trajectory. If there is a reasonable growth outlook, certainly RBI will use that opportunity perhaps to hike again.
Siddharth Sanyal, how do you look at the mining numbers at 5.1% versus 2.8% for the month of March? Do you believe going forward, because we're seeing monsoons coming in, that may mean that we may see some blip in the months to come?
Well, the monsoon will definitely have an impact, but here we are talking about year-on-year growth. So last year also around this time there was monsoon. This year also there will be monsoon. So that part can actually be adjusting. Take care of itself. But more importantly, I think in the context of IIP and as well as in the context of overall GDP number, and of late there had been a lot of focus on a bit of uptick in the capital formation numbers. I'd like to highlight one particular aspect here. It's true that of late we are seeing some bit of uptick in private capex, but more importantly, the broader trend is that whatever uptick or the large chunk of the uptick which we are witnessing at the moment in case of overall capital formation is still being driven largely by public investments. There had been very significant uptick in the recent quarters in terms of public spending. So the government spending part into infrastructure had been strong, and that led to a bit of uptick in capex numbers, especially in the areas of infrastructure, etc. My sense is that it will be a far stronger story if we quarter after quarter get to see a similar contribution from private capex part also, and we are seeing some uptick in private capex of late, but our sense is that still the overall momentum is not very strong, and the overall momentum in capital formation, and thus to a significant extent for overall GDP also, depends quite significantly at the moment on public spending. Now that's a policy decision, whether the government would like to continue with that, as well as that particular aspect will be facing certain degrees of constraints if depending on the revenue stream of the government, as well as some of the factors which we are witnessing at the moment, for example potential loss of excise duties, etc., from the because of uptick in oil prices and all. So we need to be very, very careful before interpreting too soon that growth is coming back in a very significant way.
Absolutely, and the government is on a fix with respect to its fisc also, as you very rightly pointed out. But let me take it across to you, Mr. Bhattacharya. What do you make of the fact that the gross fixed capital formation, the indication for investment in Q4 FY18 grew at about 14.4%, the highest in 7 quarters. How big do you think the jolt will be in terms of the rate hikes that we've seen to the nascent recovery, and also the fact that private investment is still not coming in the way we were expecting it to be? We're still seeing little green shoots, but full-fledged recovery in private investment has still not happened.
No, it is. You're right. So we are all we're talking from the Axis House. So I have a somewhat different view. So I think the Reserve Bank of India, given the numbers that we are seeing in terms of the growth, and we seem to agree that growth is still relatively, is uneven, and inflation is more or less on expected lines. And remember that the way that interest rates have risen is a real worry now, because with the liquidity constraint that we have, with the interest rates having risen, I think the cost of funds, cost of funding, cost of financing investment has gone up significantly. So I think at this point in time, there needs to be cooling down of rates. The Reserve Bank of India is trying various ways. The government is working with the Reserve Bank to try to see how to cool down rates and infuse more liquidity in the system. But the system is not stable. The system is not at all stable. I think there are significant risks to growth. And that needs to be taken into account in the Reserve Bank's formulation of policy. My own estimate is they will probably not hike in June. Wait and watch how things happen.
In fact, let me also ask Maithili. Maithili, do you also believe that the RBI was a little bit cautious this time around? That's why they decided to maintain the neutral stance and come the next policy. They will hold on to that fire and perhaps look at cooling off the rates, or will it be too soon for them to go ahead and go back to their stance, given that they've already done a 25 basis point rate hike?
Well, I don't think there's any question of them returning the clock back on the rate hike. The question is really whether they will maintain that neutral stance or they will change it to hawkish. So I think a lot depends on what the Fed has to say tomorrow. And though it is well known that the Fed will hike rates because they are more or less stuck to what they have said, the tone of the statement that comes out is also very important. Because remember, the big question is whether the Fed will hike rates thrice or 4 times this year. And given that the fact that the US economy is firing on all cylinders and Trump has a very aggressive fiscal stimulus in place, I think the chances are that the Fed tone might be much more hawkish, in which case I think my sense is the Reserve Bank will not change the rates in June. They are not likely to hike it, nor are they likely to reverse it. They will maintain status quo on rates, but quite possibly the tone will become hawkish, because remember, the Fed is virtually the central bank for the entire world, as Urjit Patel pointed out in his piece in the Financial Times, and the Fed frankly will not give a damn about what happens to emerging markets. It's each one for ourselves, and so there may be even a case for changing the tone to hawkish.
Very rightly put, Maithili, each one to ourselves as far as the emerging markets are concerned. Mr. Shivakumar, how do you see that the RBI is going to react to the Fed's statement come tomorrow, and what will be the key points that they should be watching out for?
Very clearly, the international factor has been a driving factor for RBI to put up rates in this last meeting. So if the Fed does sound a lot more hawkish, that will make the RBI also sound a little bit more hawkish going forward. Now, I'm not entirely sure whether they will want to change the stance immediately, because staying on neutral, they have already done one rate hike, and before that we saw a rate cut, and before that a reverse repo hike. So it clearly the meaning of the word neutral for them means we can do what we want to do. So this stance allows them to do exactly what they feel like at every meeting, and so that flexibility, they will keep it open. And I think officially putting up the stance probably they feel is a much stronger guidance that they will want to hike in the future. So I think while the markets have more or less discounted a few more rate hikes to come, I'm not sure whether the RBI is in the mood to change the stance. I think the Fed outlook is quite important. There is a reasonable chance that the Fed will put in 4 hikes for the full calendar year, which is a little bit more than what probably markets are expecting. But I don't think that at the margin is necessarily going to be very disruptive. In the last few days, maybe a couple of weeks, we've seen some easing off of global rates. We've seen the dollar kind of stabilizing. We've seen oil kind of stabilizing. So unless we again see a risk of all of that changing, that is global yields going up or oil going up and currencies once again selling off, I don't think RBI necessarily needs to worry. It's a one-time repositioning which has happened. Okay, fair enough. But I don't think RBI is going to be in a hurry to do a stance change following the Fed. They have time on their hands.
All right, on that note, let me thank our panelists, Siddharth Sanyal, Saugata Bhattacharya, Maithili Busnurmat and R. Shivakumar. Many thanks for taking your time out and speaking to us at ET Now. The IIP numbers just came in. While growth has risen, but inflation coming in at a 4-month high, although steady, still much in line with the RBI's own comfort level. With that, it's a wrap on this edition of our special programming on the state of the economy. Many thanks for watching.